So when I started my PhD program, there were two major ideas in the finance. They were the things that people spoke about a lot, did a lot of research. And the first one was rational equilibrium pricing models. And the second was the Modigliani-Miller capital structure irrelevance. So I had something to say about both these issues. Okay. So the first one was, so these rational equilibrium pricing models are mathematically very appealing because they sort of, and when they first came, things like CAPM, it was, people said, wow, we now have a theory for why prices are what they are. And if you don't have a rational model, you really can't solve a mathematical model. You have to have these assumptions of rationality. Otherwise, anybody can choose any ad hoc assumptions. So the fact that these models were able to use rationality assumptions, which are much more respectable than some ad hoc assumptions about human behavior. For example, that humans save a certain percentage of their income, and therefore if the government pumps up spending, the GDP is going to move to a higher level. That's just an ad hoc assumption about human behavior. So the rational models were based on rational humans, and they, of course, were very respected and had a very great influence, and they came around in the 60s. So by the time you get 10, 15 years later, then they started empirical data. There was empirical work done which started contradicting these models, and specifically CAPM was contradicted by this thing about the size effect, where CAPM says that the only thing that should matter for the returns to assets are their betas, whereas the size effect said, hey, you take smaller farms, that characteristic also leads to higher returns. That was the first sort of empirical attack on these models. A more stronger attack came from this paper called the equity premium puzzle. Okay, and what it basically found is that the excess returns to US stocks was approximately 1% to 3%. Should be 1% to 3% if you have reasonable levels of risk aversion. Instead, what we are seeing was they were like 6% to 7%. Alternatively, you can say that stocks were being priced too low and were therefore generating too high a return. And this criticism, brought forth a lot of research, and they were like trying to salvage the rational models, equilibrium models. I looked at these models and said, look, prices and returns are not the only implications of these rational models. Volumes are also an implication of these models. Now, the essential point is that if you really have rational traders, there should be very little trading going on, because these traders have the same information. They understand that the other person they are trading with, the counterparty, is equally smart and has the same information. In these rational models, there's no information asymmetry. If you introduce information asymmetry, then where do you stop? Okay. So these rational models are based on no information asymmetry. no incorrect assessment of a person's own ability. That is rationality. And if that is so, why would people trade? Because the person who's selling thinks that, okay, I'm smarter, the guy who's buying is dumb, and the person who's buying, because the price of this is going to fall, and the person who's buying says that this person who's selling it to me is dumb because this price is going to rise. So there is a difference of opinion, and that cannot be, that is not possible in a rational model. In a rational model, there is a reason for trading, and the reason for trading is that people have different levels of risk aversion, and you take a very simple model where you have, let's say, a riskless asset and a risky asset, and people, they make their, depending on the risk aversion, they have their optimal portfolio. People who are more risk averse will have less of the risky asset in their portfolio. People who are less risk averse will have more of the risky asset. People who are less risk averse will have more of the risky asset, and people who are more risk averse will have less of the risky asset. Okay, so that's the rational reason for trading would be if the price of the risky asset changes, then those proportions in their portfolios will change and it will move away from the optimal. So the people who with different risk aversions would trade with each other. And how much, and how would that trade go? Suppose the price of the risky asset went up while its risk remained the same. So the standard deviation, let's say, remained the same. The price went up, so the fraction of risky asset in the portfolio for all traders went up. Then the traders who are more risk averse will want to reduce the amount of risky asset in their portfolio, so they will sell to those who are less risk averse, and that's when trading. So that's a rational reason for trading in a rational equilibrium model. And where does that lead us? Well, so you can do it. You have a reason for trading, and you estimate how much that trading should be. Just like in the equity premium puzzle, there was an estimate done where they estimated how much the equity premium should be, and they found that it was completely out of whack. It should be like 1% to 3%, whereas they were observing 6% to 7% in the economy. So similarly, I did a estimate for volumes, and what I found is that if you have whatever the transaction costs are really going to reduce trading. So for observed transaction cost, the volumes in the markets were about 20 times higher than what the rational models were saying. The point is that you're trying to rescue these rational models, but prices and returns are not the only prediction of these models. Volumes is also a prediction, and these models totally fail when you try to explain volumes using these models. I mean, the obvious explanation is that for these larger volumes is overconfidence. When people sell, they believe that they know better than their counterparty. They believe that the price is going to fall, and the counterparty does not know that. They know better. That's why they are selling, and vice versa for the counterparty. So they're both at least one of them is overconfident. One of them may be kind of made the right estimate of the price, but there's certainly at least one of the party is overconfident. So again, you have this problem with rational equilibrium models, and that can't be explained. These volumes can't be explained by some of the things which people were trying to explain by changing, modifying those models. Or at least I didn't see any attempts to explain larger volumes, because I thought it was a problem, the larger volumes, but the rest of the profession did not think it was a problem. I don't know why. Okay, moving on to Modigliani-Miller. So the Modigliani-Miller capital irrelevance suggested that firms that had a positive NPV project will receive financing. Okay, so positive NPV projects are not going to be denied because the firm can't borrow money or raise financing. If they are denied, then Modigliani-Miller capital irrelevance is no longer true, because then you have firms which are having to forego positive NPV projects because of their capital structure, so which will lead to a fall in their value. So then capital structure is no longer irrelevant. So Modigliani-Miller implies that firms should not face a cash constraint because of their capital structure. And the way it was tested is that they took a large data set to test whether firms with higher leverage invested less. Higher leverage, they have more debt, they have to pay more as interest, they have less money left to invest. And so, there's a regression run, and leverage turned out to have a negative coefficient. Then came what economists do, and they said, hey, wait a minute, you found a correlation, but it's not causality. Yes, it doesn't mean that negative coefficient doesn't mean that higher leverage is causing lower investment. It could also mean that because a firm has lower investment possibilities, it also has a history of having lower profits. Lower profits historically, lower investment possibilities. Lower profits also lead to higher leverage. So it's not, the causality is not going from leverage to investments, it's going from actually whatever investments you're seeing back to leverage. So this is what is also called the endogeneity problem. And to address it, they used control variables. But when you use control variables, you're just throwing something to the regression and hoping that it'll clean up whatever endogeneity there is. I mean, there's really no good theory to say how much it'll clean up or how it should work. And it introduces multicollinearity, where there are different variables, each competing, trying to explain, fighting with each other, trying to explain why the explained variable is what it is. And I found those regressions very messy and very unappealing. This whole thing of control variables was... So what did I do? Well, I said, let's get rid of this control variables. You're worried about leverage having this endogeneity problem. I'm not going to use leverage as the explanatory variable. What I'm going to do is I'm going to break up leverage into its components. And why components? Because leverage is like this sum of all different things, but the components themselves may tell us much more about the world, what the world is. Right? I'm going to break up leverage into old leverage and change in leverage due to equity issues, change in leverage due to debt issues, change in leverage due to dividends paid. Now, these are all things which can contain information. Equity can, a firm may issue equity in a certain circumstance, it may issue debt in circumstance. There was also, I'm pretty sure I also had another one here, and that was change in leverage due to income. Or if you're using financial statement, it'll be net income. Okay, so look at the components and see what kind of coefficients they have. And the results were super. It was like as beautiful as a poem. It went exactly as you would have expected if there were informations in these variables. The component of leverage due to recent earnings had a very highly negative coefficient with investment. And that again is because recent earnings will push down leverage. And if there are high recent earnings, it means the firm also has good investment opportunities. So the firm with the component of leverage due to recent earnings had a very negative coefficient with investment. And then you went back in time, you look like, let's say 2 periods ago, what was the impact of the component of leverage due to earnings? It again had a high impact, but less than the recent one. And then as you kept going back in time, the impact died out. And when you like went back in time, all these things which as you go back in time, you would expect them to have less information, and then they all converged. See, they sort of like got towards close to each other, and that is the impact, that convergence is the impact of leverage on investments without information, without endogeneity. So this was a method to address the endogeneity problem and make an accurate estimate of what the impact of leverage was on investment. The results are beautiful. And what else did I find? That coefficient was about 9%. And what is 9%? 9% is actually more than what firms pay on their debt. What do firms pay on debt? Maybe 7, 8 or whatever. So what it was telling you is that firms with high leverage, high amounts of debt, are not only investing less by the amount of interest payments which they are making, but are doing something beyond that. So not only are they constrained because of the interest they are paying, but they are actually reducing their investment even further. And why would they do that? They would do that because firms with high leverage want to move to a situation of lower leverage. So they're ready to forsake positive investment projects because they want to get to a lower level of leverage. Management is afraid of leverage. They don't want to go bankrupt. So they don't want too high leverage. And so they're not only reducing their investments by the amount of interest they're paying, but they're also, if they have high leverage, then they are reducing investment further so they can move to a lower leverage. And on the other side, firms which have low leverage are investing more because they have to pay less interest, And also they're investing more because they feel comfortable about increasing their leverage. So I call that like the super cash constraint hypothesis, where the impact of leverage actually went beyond the amount of interest that was being paid. It went to, it actually went um, to an impact beyond the interest level. It has like very big policy implications. You want to understand how the economy works, then you understand that firms in the economy are constrained from uh, taking on uh, positive NPV projects because they have high amounts of debt. So then your policy should try to figure out how do you make it, like how do you ease their cash constraint.